Hello and welcome to Policy Watch, your packed snapshot on the week's biggest business developments, their context, relevance and impact. I'm Govindraj, Ethiraj. This week, Prime Minister Narendra Modi opened a direct line of communication with the bureaucracy. Now, the idea was twofold: to streamline the functioning and to invite new ideas for execution. On Wednesday, the Prime Minister met 77 secretaries to the government who head their respective ministries. Now, this is the first time that top bureaucrats got an opportunity to interact with the Prime Minister without their ministers. Let's take a look at this report.
In a freewheeling discussion, Prime Minister Narendra Modi heard problems and sought solutions. He asked the country's top bureaucrats to take a leadership role and expedite decision-making. He assured them of protection against malicious prosecution for bona fide decisions. The fear of prosecution was cited as the biggest hurdle in decision-making, especially in the wake of the 2G scam and the coal scam. After the meeting, the Prime Minister tweeted, had a very fruitful meeting with secretaries, heard their views and asked them to simplify administrative process and make government people-friendly. Modi also asked the bureaucrats to approach him directly with new inputs and ideas. Government sources said 16 groups of related departments have been formed. In Group A, all the departments under the Finance Ministry are clubbed together. In Group B fall energy-related departments like power, coal, mines and atomic energy. Agriculture-related departments are in a separate group, while infrastructure-related departments like railways, telecom, roads, civil aviation, shipping and posts have been put together. The secretaries were asked to make a 10-minute presentation for the Prime Minister, listing out the action points for the next 5 years.
Well, joining me now to discuss this issue is CRISIL Chief Economist D.K. Joshi. Mr. Joshi, thank you very much for joining us. So, this is unusual, the Prime Minister of the country meeting directly with bureaucrats and the heads of their respective departments, 77 in all. What are the key issues that we should be thinking about that perhaps this new way of working or debottlenecking will help?
Well, I think the last couple of years have been plagued by very slow decision making. I think decision making had almost come to a halt. And we also know that a lot of projects are either stuck or, for instance, there are issues in coal mining, there are issues in iron ore, and just trying to figure out what is it that is not letting the investments happen. I think the sentiment was definitely weak. So, but apart from that, and are there any administrative hurdles? So, it's a way of finding out what the problem is. For instance, the Cabinet Committee had cleared projects worth 6.5 lakh crores, but why are they not hitting the ground? So you need to get to the second level. And I think we all know that the bureaucracy was on a slow mode right now, and it needed to be perked up. So I think it's a part of the process of pushing the administrative part of the reforms.
So you talked about coal mining and iron ore. So let's look at it from the other side, right? So if the target is to bring back growth to a higher level, what are the sectors or areas which were impeding it the most because of maybe lack of sufficient policy action?
Well, I think it is the sectors where there was more judicial activism. It's the sectors related to environment. It is the sectors where I think the scams came up. So I think those are, again, that becomes coal, iron ore, and also I think the road sector, which has, I think, where environment plays a very critical role. So I think these are the sectors which were hit by this so-called policy paralysis.
So where would you like to see quicker action in these so as to...
Well, I think first of all you have to pick the low-hanging fruit. I think because the bigger reforms can happen. But the low-hanging fruits would be, for instance, I think fast pacing the availability of coal to the power sector. I think that would be one. Then in the road sector, for instance, there are a lot of patches where I think the roads are held up because of just a small non-clearance of environment. I think that could happen quickly. So I think these small things, administrative things, need to be got out of the way first. I think that is what will bear fruit very quickly. Reviving new investments will take time because the capacity utilization itself is so low in the system that why would anybody put up a new power plant or why would anybody put up a new automobile plant when the existing capacity is not getting utilized?
Can you give us some figures there in terms of
I
power
think,
and
if you look at the power sector, the capacity utilization in the thermal power stations is around 60%. It should be optimally around 85%. Either it is the non-availability of coal. Now I think what's also hurting them is the demand offtake has reduced because the industry itself is not growing. So if the capacity is not being optimally utilized, it will create financial stress for these firms, and also I think can translate into NPAs and so on and so forth.
So that's a good point. But if you're saying that they can be debottlenecking from the supply side, but if there's a demand side problem, how will this new, let's say, way of functioning, more bureaucratic power help?
Right. I think because the demand will also be created. For instance, if the iron ore sector picks up, let's take the example, it will also generate employment. It will also, I think, so the process will kickstart. You cannot push demand up right now through interest rate cuts or through fiscal policy. Only thing left is the structural part of the reforms, and there too legislative reforms will take time. So you have to first address the administrative part of it, and I think that's what he seems to be doing right now.
Okay.
And that is where the bureaucracy is also involved, and you need to oil the machinery.
Right. So you talked about the low-hanging fruit. What's the not so low-hanging fruit?
Not so low-hanging fruit would be GST, where I think, which is much talked about, much required, but you'll have to take you'll have to take everybody together, get their consensus, and so on and so forth.
And that goes beyond just the 77 secretaries at the federal level.
That's right. And then you have labor laws, I think, which is again talked about, because revival of manufacturing is also to some extent linked to labor laws. So, for instance, the labor-intensive part of manufacturing. So, labor laws, how do you make them favorable? It's a big question. So, full-fledged labor reforms may not be possible, but you might be able to do some tweaking here and there, or maybe involve the states more. People are talking of increasing the workforce, or right now 100 people. If you employ 100 people, you come under the purview of labor laws. Maybe they'll make it 200. Things like that, I think. But these are big reforms which will take time.
Yeah. So that also brings me to my next question. So some of this will then slowly move into reshaping of regulation itself, or rewriting regulation.
I think it could.
Or legislation for that matter.
It could. I mean, it could. But that is, I think, that requires both the houses of parliament. It requires more consensus making. So I think those things you cannot put them in the slow burner. But right now, I think what can be done quickly is what should be focused on, and what is easier to do, so to say.
Right. And we had the GOM, or the group of ministers, in the EGOM, the extended group of ministers, empowered group of ministers structure. Is this new way of working likely to be more efficient or effective?
It is definitely lighter, because you'll reduce the number of intermediaries in the system. So it can work more forcefully.
Right. So what's the one area that you would like to see quickest movement at this point of time? Again, from an economy or the larger economy question.
Well, I would want very quick action on the coal and the iron ore.
Okay.
And I think that's what is going to yield multiple benefits. I mean, both for the power sector and also for the, I mean, if the iron ore mining starts, your current account deficit pressure reduces, and at the same time you give an impetus to manufacturing also. So I think these have many spillover effects, and these are the sectors which have been most bottlenecked right now. And then I think there are roads, and there are many issues. I mean, it's not easy to sort them out, but at least some debottlenecking will help. Look at it right now. I mean, the efficiency of the economy is very low. I mean, it would have come down by 30 to 40%. So you have made investment that's not yielding results. It's not yielding returns. So it creates financial pressure for companies.
Right. So when you say efficiencies come down, can you illustrate that?
I think we measure efficiency as incremental capital output ratio. Are you getting bang for buck for the money that you have invested? And the incremental capital output ratio has worsened by 30 to 40%. It should ideally be around 4. It is around 7.5, which means the existing investments are not yielding results. Whether it is due to low capacity utilization or it is due to bottlenecks, both of them put together have created a condition where there is no incentive to invest further right now.
Right. So you're saying basically there is a challenge of first filling up existing capacity, particularly in areas like power. The second challenge, of course, is to bring in fresh investment, and that's why a lighter structure might help. Now, what are some of the softer challenges, if one may so, and that could be addressed with a lighter approach to government and governance?
Well, I think I couldn't get it. I mean, could you elaborate on by softer challenges?
No, what I mean is, so this is the physical stuff. I mean, this is the heavy lifting, right? Literally. I'm saying, what else could there be, maybe by virtue of signaling or virtue of sentiment?
Well, I think more transparency in the system. I think you can use the technology to make the system more transparent. I mean, I would look for fiscal transparency, for instance. I think there are many smaller things that could become possible with a lighter structure. And I think what may also happen is, I mean, if you lighten the structure further, and there was an attempt to bring club ministries together, and I think that also yields benefits, because sometimes ministries linked to each other work at cross purposes. Fertilizer ministry, agriculture ministry, and food processing may not work, maybe may not be on the same page. I think they should be all working towards the common goal, which is increasing the agriculture supplies or whatever it is. But sometimes their actions they move in other directions. So I think bringing them together, I think that can yield. These are called coordination benefits. I think there'll be better coordination. I mean, if you have a lighter structure.
So this is almost your. I mean, we've talked about low-hanging fruits. We've talked about the bigger challenges, and so this is somewhere in between. Would you say that?
Yeah, I would agree that. I mean, I think this will happen gradually. I mean, once you lighten the structure, you'll see the benefits being reaped off.
And do you see or feel that some of this can be visible in the next maybe 8 to 10 weeks and beyond?
Well, I think that would be clear from if the projects that were cleared, I think they are hitting the ground. I think that can be monitored, and that should be transparently put out also, so that people know. I think that is where you will see a quick action. I mean, I think that is what should be visible. New investments will take time, because first the pipeline has to be created, and the pipeline then will start hitting the ground after 18 months. So there's a lag of about almost 2 years.
Right. And what is your estimate of the kind of investments that are waiting to come in some of the areas that you spoke of earlier and beyond that?
Well, I think infrastructure is a tough nut to crack. We need investments there, and maybe government will have to step in there as well, because right now the environment for the private sector, look at the finances of power companies or the road companies, they're pretty stretched. I mean, they are being given concessions. Even in power, a lot of projects are getting renegotiated because coal is now imported, coal is available. So there's a lot of activity going on there. But I think apart from that, I think where you could see action after some time is, I would say there are other sectors like textiles, etc., where there is a global opportunity with Europe lifting, right. US lifting. I think this sector could see quicker investment than food processing, where I think the need is to curb food inflation. So you could give impetus to food, and there's lack of investment there actually.
Right. So we touched upon GST, and the reason I would want to revisit that question is because finally a lot depends on center state, and particularly getting a lot of efficiency on ground. Will this lighter structure, or potentially can it, and therefore should it, explore this or work on this in a better way so that to...
I think that is more a question of statecraft, how you take others together, because states also try to get mileage out of this. I mean, they'll try to extract some concession for giving their support to that. I think so, and at times there are partisan issues. I mean, the partisanship has increased, I mean, of late. So I think if you take people together and you work towards a common goal and you agree, I think how Mr. Modi manages to bring other political parties on board for some of the things of national interest, I think that is yet to be seen.
Right, but you do feel that a lighter structure also enables, economically speaking, more efficient center state actions, and
it could. It is yet to be tested. Yeah. It is yet to be tested. But I think it is definitely because some of the excess ministries created were not required. I mean, they're just, I think, maybe I don't know the rationale behind them.
Well, we'll take a break on that and come back and discuss the Reserve Bank's second bi-monthly monetary policy. You're watching Policy Watch. Welcome back to Policy Watch. This week, the Reserve Bank announced its second bi-monetary policy review. Let's take a look at this report and understand what it has in store for us.
The Reserve Bank of India voted in favour of a status quo earlier this week. RBI Governor Raghuram Rajan didn't tinker with the short-term interbank lending and borrowing rates, also known as the repo and the reverse repo rate. The rate at which the banks borrow from the RBI was kept unchanged at 8%, and the reverse repo rate, the rate at which the RBI sucks up excess liquidity from banks, is maintained at 7%. However, in an attempt to increase liquidity in the system, the RBI has cut statutory liquidity ratio, or SLR, by 50 basis points. This brings it down from 23% to 22.5%. This is expected to make available additional 40,000 crores with banks for lending. The RBI has kept cash reserve ratio CRR also unchanged at 4%. The Apex Bank says that if the economy continues on the disinflationary path, further tightening will not be warranted, and if the process is faster than expected, it would provide room to ease the rates.
Welcome back. You're watching Policy Watch. Still with me, Crystal Chief Economist DK Joshi, and we're going to be talking about the monetary policy review from the Reserve Bank of India. Mr. Joshi, the repo rate has been held at 8%. The consumer price inflation target is now under 8% by January 2015. We're basically narrating the key pronouncements from the Reserve Bank. 6% target by Jan 2016. And yet we have a very high inflation rate. We're also concerned about what lending rates are and where they could go. Sure. What's your key takeaways from this time's monetary policy?
I think monetary policy was as expected. I think there's no big change here except the SLR shift downwards. I think, but that's not material at this juncture. It's only very, very indicative. Very mildly indicative. I think the critical message from here is that the ball is in government's court. RBI has been keeping its interest rates firm for some time.
Right.
Two things to be watched out from the government side. Number one, what kind of fiscal policy we get. Do we see fiscal restraint? Do we see fiscal consolidation? We're getting positive noises on that front, and I think that litmus test is in the first week of July when the budget is presented. That is number one. Second issue, I think, which is more difficult to deal is the food inflation part, and I think food inflation has been a major contributor to inflation. The new metric which RBI uses is consumer price index, and that has a very high weight of food inflation. So how do you bring food inflation down? Structurally, because it's not that it's monsoon related alone. Even in good monsoon years, we've seen food inflation spike. So it is a more entrenched problem, and there I think
for which the Reserve Bank can do very little.
Very little, but I think if government doesn't do, then they can do very little to promote growth. So there's a coordination required. First of all, fiscal policy should be in same page as the monetary policy. If monetary policy is tight, fiscal policy cannot be loose. So that I think we've seen some coordination there. Second is more proactive action by the government to bring food inflation down, and I think there are ways to bring it down, and you need not increase production right away. I think you can, even if you improve the efficiency of food distribution and many other things, I think you can.
Right. So let's get a sense on where we stand today in terms of overall lending and credit growth.
Well, credit growth is weak because economy itself is weak, and it might pick up this year. But so lending activity, first of all, there's not much demand, and there's also less willingness on the part of the banks to reach out to the corporate sector and lend out to them, particularly related to infrastructure, because they have a bad balance sheet problem. Unless they clean their balance sheets, unless they reduce their NPAs, their ability to go out and lend further also reduces. So I think from both the sides, the economy itself is weak, and the proclivity of banks to lend is also weak. So you have a low credit growth.
Right. So, and there's the monsoon factor somewhere in, are you, what could be the impact of an El Nino if it were to come back?
Well, I think right now the monsoons have today hit Kerala, but I think the point is it is still unclear because the El Nino risk still persists. Whether it will play out or not, that is a big question mark. And even if we see normal rains in the month of June, that doesn't necessarily mean that July and August will be fine. So I think you need to monitor it very closely.
Right. So that's a question mark that's going to hang over us.
That's a risk we have to manage, and you have to be prepared for that.
Right. So let's come back to what the Reserve Bank can do and cannot do till the next review.
Well, I think Reserve Bank is on hold, and I think they'll wait and watch for what happens in the fiscal policy, and they'll also look at the progress on the monsoons. These are the two key monitorables for them at this juncture. And fiscal policy is a bigger monitorable because it's in the control of, it's in our control. Monsoons is a rather uncontrollable risk.
Right. Now, what about interest rates? There have been hikes in interest rates between September 2013 and Jan 2014. Right. What has the impact of that been so far? And where do we need to go from here?
Well, I don't see much impact of that as yet because interest rate hikes reflect in the core inflation. And core inflation has only very mildly come down. So I think one can say that there is a lag.
Or does it once again demonstrate that there is very little linkage?
No, it could. You have to wait for the lag. There is little linkage is not very strong. I think that's a cause of concern. But what is also true is there is a lag. So if you reduce interest rates or raise interest rates today, it has a material impact on inflation maybe after 1 to 1.5 years.
Okay.
So that is yet to play out.
Okay. So what are the other areas that the Reserve Bank ought to be or could be looking at?
I think right now inflation is the prime concern. Okay. I think other things are, bank NPAs. They have to, they should be monitoring it very closely, I'm sure. And then there are there's Nayak committee report, how it gets implemented. I think there are many things happening for the Reserve Bank to
So that's at the structural end. So as for home borrowers, people who are either taking loans or wondering what to do with their existing loans, roll them, swap them, what is the
Well, I
outlook?
don't think they should expect loan rates to go up, and I think they should also be on hold. If the central bank is on hold right now, I think you stick to whatever you have. But I think what has also happened is that at least people who are linked to the financial markets, at least their returns have gone up, particularly in the equity market. So that should provide some cushion to.
So I mean, yeah, exactly. I mean, I was going to come to that. I mean, we are seeing record highs in both the Sensex and the Nifty, and we've hit another record high just yesterday. Now, what's the impact of this going to be in the overall economy, if one can?
Well, it has a positive impact because it creates wealth effect, and not many people are linked to the stock market, so the wealth effect is very concentrated. But yeah, I think it is going to create. It first was sentiment, and then second was wealth creation, and I think it's going to be positive, but it has to be backed by action, real action on the ground, which means GDP growth picking up, industrial growth picking up. Unless those happen, then these things tend to fizzle out.
Right. No, but and what about companies and their ability to either raise debt or equity given the current market conditions? Both.
Well, I think it will improve. I mean, because but as I said, let's wait for some more time. I mean, but things are on the positive, moving towards in the positive direction for even for companies to raise funds. Eventually, if the growth actually picks up, and financial markets doing well is a good sign, particularly equity markets, but this is very volatile also, and I think so you need to wait for other drivers of the market. Sentiment is one driver. It's driven purely by sentiment as of now. I think the real economy has to pick up, and then I think the virtuous cycle starts.
So I asked you about interest rates. I mean, particularly from a retail and a home loan borrower's point of view. Should they be worried? Okay, I mean, one is to say that whether it will go down or not, but is there any cause for worry from your point of view?
Well, I think they won't go up. I mean, it doesn't look like.
That's quite clear.
Yeah, that doesn't look like. It would be then if they go up, then we are in a stagflationary situation. I mean, or stagflation-like situation, which doesn't seem to be, because now I think at least steps are being taken to push growth up, and it's also agreed that interest rates were not the main reason behind low growth. So interest rates cannot revive the economy up also very quickly. So it is the other part which is going to revive economy up, and the focus has shifted to the other part. So I think that's a good news.
Right, but at the home owner again, is there some benefit to be derived from, let's say, lowering interest rates and giving people the incentive to go out and maybe consume more or spend? And
well, there is. I mean, but the point is, it also becomes inflationary. We've seen that in the post-Lehman crisis period. The GDP growth went up very quickly. If you look at that period, the consumer inflation was the highest. I mean, though it was around 12.5%. The wholesale price index inflation was below 4%, but the consumer push was so much. I think so much of demand was generated. So you have to be a bit cautious, and I think right now I think you can err on the side of caution. I mean, because you've seen very high inflation for a very long time. People's expectation on inflation haven't got mellowed. So I think to do that you need hard action, and I think both the central bank as well as the finance ministry together, I think if you crank down on inflation, then I think it will you'll find that the low inflation regime will start taking hold.
And last point, I mean, linked to this, of course, is do you have a take on the rupee?
Yeah, I think I believe that rupee will settle around the current levels only. I don't see a much upside to it. I mean, that's our forecast based on fundamentals. But sentiments can always drive a wedge between fundamentals and the actual value. And this is what we have seen in the past as well. Because current account deficit will move up a little bit, your GDP growth is going to pick up, so imports are going to rise. At the same time, you'll take away some of the restrictions on gold imports, so gold imports will also increase. So CAD will pick up a little bit, which is, I think, right now it has been corrected to very comfortable levels, but it is going to move up from here. And also, I think we also depend on pull factor is very good. So you might get a surge of capital inflows and rupee might start strengthening again. But I think it will remain volatile.
So outlook on interest rates reasonably positive, outlook on rupee reasonably positive, on growth reasonably positive, and broadly I think holding pattern till we wait for fiscal policy.
Growth, I think it's not going to surge, but I think it's definitely going to bottom out, and I think it's going to be a very slow grind. The ship is very big, and I think it will take, first you have to turn it around and then give speed.
Let's hope it turns faster. Thank you very much for joining us, Mr. Joshi. That's all we have time for this edition of Policy Watch. We'll be back.